Hey everyone, welcome to the channel. My name is Ivan Prodayka. I'm a private investor and the creator of MeCompounding tool. If you ever opened a financial report and thought, what I'm even looking at, this video is for you. Today, I'm going to show you how to read the financial report step by step using Microsoft as a real-world example. We'll walk through what 10K and 10Q reports are, how to read the income statement, balance sheet, and cash flow statement, what to listen for in earning calls, and how analyst expectations can move the stock prices even when the numbers look good. So whether you are new to investing or just want to sharpen your analysis skills, let's get into it. So let's start with the basics. What is a publicly traded company and why did the company even go public? A publicly traded company is one whose shares are listed on a stock exchange, like New York City Stock Exchange or Nasdaq, and are available for anyone to buy or sell. But before a company gets to this point, it has to go through a process called initial public offering or IPO. And before the IPO happens, the company has to go through the serious financial audit. Independent firms like Deloitte come to review the company financials. They verify the accuracy of the company's books, check the accounting standards are being followed, and make sure the financial data is reliable for future investors. This step is critical because once shares are on the public market, investors rely on that data to make real decisions with the real money. There are two main reasons to go public. First is to raise capital. By selling shares to the public, companies get access to money they can use to grow, whether that means an expanding into new markets, hiring more people, or building new products. Second, so early investors and founders can cash out. Before the IPO, ownership is typically limited to the founders, employees, and venture capitalists. When the company is public, those shares become liquid, means they can now sell them or on open markets and turn their equity into real money. And there is an interesting part. Once the company is public, is the market that decides whether what is the price of these shares. The price you see moving up and down daily, it is based on whether investors are willing to pay based on the expectations, news, performance, and yes, financial reports. That's why transparency is so important. To keep the market informed, public companies are legally required to publish quarterly and annual financial reports. Those include income statements, balance sheets, cash flow statements, and detailed commentary from the management. It's all meant to help investors like you and me to understand what is really going inside the business. The great thing is that those reports are public and free to access. But the tricky thing is that it is the knowing how to read them. Let's talk about the financial reports publicly traded companies are required to publish. The most important one is 10K. That's the annual report a company files with the SEC, the Security and Exchange Commission. It is the US government agency that regulates the stock market and protects investors by making sure a company stays transparent. Then 10K includes detailed financial statements, risk factors, business strategy, and insights from the management. It's basically the company full report card for the year. In between those, companies also publish quarterly reports called 10Qs. Those are filed every 3 months and give a short update. How the business is doing that quarter, any recent changes, and updated financials. Both 10Ks and the 10Qs are publicly available. You can get them from SEC websites or using a tool like MeCompounding to view them in a much simpler way. Inside those reports, you will find the three most important financial statements: the income statement, the balance sheet, and the cash flow statement. So let's get one by one and learn how to read them using Microsoft Excel report as our guide. Let's start with the first and probably the most talked about financial report, the income statement. This is where you see whether the company is actually making money. It shows revenues, expenses, and profits for a specific period of time, like quarter or full year. Think of it as a snapshot of the business performance. Did the company grow? Is it profitable? Are costs under control? Now let's break down the main fields you are typically seeing in an income statement.
A good way to understand the income statement is to draw a Sankey chart. So Sankey chart includes the all of the revenue streams that company possess and the distribution of the revenue. So here is an example for Microsoft Corporation for full year of 2024. The Microsoft Corporation has number of revenue streams displayed here. All of them making the revenue, the yearly revenue of 245 billions. So the revenue itself is the total amount of money a company earns from its business activities. Out of revenue, there where the company is spending cost of revenue. The cost of revenue itself is the direct cost associated with the production of goods or services like company sells, including materials, labors, and overhead, and so on. And we are ending up with gross profit. The difference between gross profit and the revenue is called gross profit margin. Out of gross profit, the company is spending operational expenses. That includes research and development, selling and marketing, general and administrative expenses. And the company is left with operational income. So the difference between operational income and the revenue itself called operational income margin. Out of operational income, the company is paying the income tax and having some other expenses. And the company is left with the net income. And the difference between net income and the revenue is called net income margin.
Additional to things that were mentioned above, there is also one more thing, the earnings per share. Earnings per share shows us what is the profit that the company has for one share on one share basis. Yeah, so the company has number of shares outstanding, and we divide the total company profit by this number of shares outstanding, and thus we are resulting with earnings per share. Now that we know how to read an income statement, let's move on the second key report, the balance sheet. The balance sheet is like a snapshot of the company's financial position at a specific point of time. It shows what the company owns, what it owes, and what left to shareholders. The three main sections are assets, liabilities, and shareholders' equity. Let's break them down.
Assets. This is everything that company owns or controls that has a value. It includes things like cash, account receivables, inventory, equipment, and long-term investments. Assets are usually split into two groups. Current assets, things that company expect to use or convert into cash within a year, and non-current assets, like buildings, intellectual property, or long-term investments. Liabilities. This is what company owes. It includes loans, accounted payables, deferred revenue, and other obligations. Just like assets, liabilities are also split into current liabilities due within a year and long-term liabilities like long-term debt and lease obligations. Other than that, there is also a shareholder equity. This is what left over when you subtract liabilities from assets. It represents the net value of the company, the part that belongs to the shareholders. There is a simple formula here. Assets equal to liabilities plus shareholders' equity. This is always has to be in balance. That's why it's called balance sheet.
Now that we've looked at how profitable the company is and what it owes and owns, let's look at how money is actually moving through the business. That is where the cash flow statement comes in. This is one of the most important but also most overlooked financial reports. Unlike the income statement, which is based on accounting rules, the cash flow statement shows a real cash coming and going out during a specific period.
There are three sections to focus on. The first one is cash flow from the operation activities. This is cash generated from the company's core business. Think of it as a business model actually producing cash. For a healthy company, the number should be positive and growing. The second thing is cash flow from investing activities. This is money spent on long-term growth. It includes things like buying property, equipment, or even acquiring other companies. This number is often negative, and that is not a bad thing. It shows the company is investing in its future. And the third thing is the financing activities. This includes the borrowing or repaying the debt, issuing or buying back shares, and paying dividends. It tells you how the company is managing capital and rewarding shareholders. At the very bottom, you will see the net change in cash. It, it is difference between the balance sheet, the balance at the start of the period, and the balance at the end of the period. One of the most useful numbers here is free cash flow. The cash flow, that is the cash from operations minus capital expenditures. It tells you how much cash the company really has left to reinvest or return to its shareholders. Microsoft consistently generates tens of billions in free cash flow, which they usually use for buybacks, dividends, and long term investments.
So, we've talked about the financial statements, but numbers alone don't tell the whole story. That's where earning calls comes in. Every quarter, after releasing their report, public companies host a live call with analysts and investors. During this call, executives walk through the company's performance, highlight important metrics, and give more context to the numbers. More importantly, they often share what they expect going forward, their outlook for the next quarter or full year, product plans, or even industry trends. At the end, they usually host a Q&A session where analysts ask through questions. This part can reveal a lot about how confident management really is and how well they understood their own business. Even if you don't listen to the full call, reading a summary or transcript can give you an edge, especially if you are investing in the long term. In MeCompounding, you can find their summaries and transcripts on the earnings calls, so you don't have to dig through the pages of transcripts yourself. Now, let's talk about something that often confuses investors: analyst estimates and how they often affect stock prices. Every quarter, Wall Street analysts make predictions: how much revenue a company will make, how much profit, and what earnings per share will look like. These estimates are published before the earnings releases, and when the company reports the actual result, investors compare them to the estimates. If the company beats expectations, the stock usually goes up. If it misses, even slightly, the stock might drop. That's why you might see headlines like Microsoft beat revenue but missed on EPS, and the stock dips 5% the next day. If it's not just about performance, it's about expectations. Alright, let's quickly recap everything we've covered. We've talked about what public companies are, why they publish financial reports, and how those reports are broken into three key statements: the income statement, to track revenue and profit; the balance sheet, to see what the company owns and owes; the cash flow statement, to follow real money in and out of the business; We also covered the value of earning calls and why analyst expectations can sometimes move the stock price more than numbers themselves. With all of these combined, you will now have the knowledge to start analyzing companies like a pro. And with the Me Compounding, you can skip the spreadsheets and get straight to the insights that matter. If you found this video helpful, feel free to give it a like, subscribe for more investing content, and let me know in the comments which company you'd like me to break down next. Thanks for watching and see you in the next video.